Anthony, and I'm very pleased to be here today from Pear Tree Canada, bringing you what we affectionately call Bobby U, Strategic Fundraising with Bobby Kleinman. A few housekeeping tidbits before we begin. We are live today. You are sitting across from Bobby and I, and we're enjoying that very much. But because we're live, there may be a couple technical glitches, a dog barking, a lawnmower roaring, and you may hear us call for help to Laura. Laura is our online producer, and she's here with us, making sure that everything goes well. Another housekeeping detail that you should know is that the opinions today are Bobby's, and they are not necessarily tax advice from Pear Tree, and that if you have any questions or you want to seek professional advice on any of the approaches that we suggest to you today, we encourage you very much to do so. Pear Tree Canada is the leading provider of flow-through share donations. I joined Pear Tree about 12 years ago. I'm a major gift fundraiser myself, having worked across Canada with organizations like United Way, Ketchum Canada, and Kids Phone. I've known Bobby for as long as my career has spanned. In fact, his books have been on my shelf my entire career. At Pear Tree Canada, we truly live up to our tagline, where finance meets philanthropy. And that's why we're very pleased to bring you today's session. What we do is offer a unique strategic format to help you work with your donors to give more. We, after 12 years and $2 billion raised with the resource sector in Canada and providing jobs in the North across Canada, we have worked with many of you online today, and we know you well, including fundraisers, wealth, tax, and legal advisors. Our unique platform is accepted widely by all professions across the country. And we look forward to helping you and raising more by ultimately lowering the after-tax cost of donation to philanthropists. Today's speaker is truly a leader and a pioneer in philanthropic giving in Canada. Bobby began his career in the early 90s in working with the Jewish Foundation in Montreal, certainly one of the best known foundations and donor-centered, an extremely important concept in our world. He also is a tax practitioner and began his career working in the tax world, moving on to philanthropy and bringing what he knows from both worlds together through his expertise to you today. Afterwards, we're going to have the opportunity to ask Bobby questions live. He will be online, and you can submit your questions through the Q&A. We look forward to working with you on answering everything. If we miss anything or we run out of time, certainly those questions will be available on Ask Bobby at the Pear Tree website, peartreecanada.com, under our Perspectives newsletter. Now, Bobby, over to you for a few minutes. Thank you, everyone.
Thank you, Marilyn. Thank you very much. It's really a pleasure to be here and to try to work with you over the next month. So first, a big thank you to Pear Tree. Why thank you to Pear Tree? Because their idea to say, let's try to teach a little bit of strategic planning across the country. And arrogantly, for me, it's like, yeah, I think I have something to offer. I'm at the end, sort of, of the career a little bit, and it's time that I try to pass on arrogantly what I think I have across Canada a little bit. So what a great opportunity for me. Now, for Pear Tree, it's like they're doing this almost as a gift to charities, to say, we're giving you a gift of this, whether it's a good gift, bad gift, you'll determine later. And we know when you give a gift, you get a receipt. They're not going to get a receipt for that, but because it's not a cash gift, you've got to evaluate it, right? We all know that to get a non-cash gift, you've got to evaluate it to determine its value. So we ask you to evaluate. Every seminar, when it finishes, there'll be an opportunity to evaluate. Why is it so important? Because we're doing 4 seminars. Then if you give us some evaluation, some tips and whatever, how you think this can get better, we'll be able to adjust ourselves as we go along. So please do that. Now, Pear Tree has on their website, as you saw, the handbook. There's their newsletter, which is there, and other things there, including the slides, which we're using today, and as we go forward, we'll have it there. So slides are important because that's going to be part of the course, how you are going to take the slides and use them for your own uses. Okay, so what's this course going to be like? It's not as technical as you might, especially the first one. It's not as technical as you might think you usually get from me, because usually I'm very math-oriented, numbers-oriented, and whatever, and you're going to get that. But we're going to try to do a little bit less of that and look at other factors that are involved in this. Who have signed up for this? Well, many of you, of course, work for charities, and it's aimed at major gift solicitors for charities, and there's many of you who've signed up for it. There are many allied professionals, accountants and others who've signed up for it. The techniques should work the same. Again, we're going to start to look at the donor itself, understanding the donor, and to see where that goes in terms of planned giving. An allied professional can look at that too, can say, let me look at my client first, understand them, and therefore say, what's the good thing? What's the good product to introduce them to? There's also a group that signed up. I really couldn't understand it. Circus performers, a fair number of circus performers signed up for this. Trapeze artists, I don't know. Maybe are those fundraisers working for charities, trying to balance their lay people and the donors and the needs? Those are the circus performers that have signed up. So we're all in this together, and we'll see where we're going to go with this. Now, the seminars are 4 seminars. Today, we're going to try to understand the donor a little better and process of doing this. The second one will be technical. We'll be looking at insurance, mining flow-throughs, marketable securities, charitable remainder trusts, and ideas. The next one is going to be a little more different for people because we're going to look at the corporation, why it's so important, how to give gifts in the corporation, how to give gifts of shares of corporations. And then the last one is going to be a case study where we bring everything together. Today's one talks about relations with donors and how strategic giving affects that. We're going to try to understand the donors. So this is different. Typically, someone goes to a strategic planning seminar or plan giving seminar, and they teach you marketable securities, charitable remainder trusts. We're first starting with the donor. And the objective here is to say, how do we start with a donor and move with a relationship into the proper plan giving mechanism or strategy mechanism? So a little less technical today, more motivational, spiritual in some ways, except at the end, because I can't help myself. And at the end, we're going to play a little bit and have a little bit of fun. So we can put the first slide up. So just to look at fundraising in itself. So obviously the goal of fundraising efforts, and we're talking about major gifts now, is to identify people who might want to donate to your organization and cultivate relationships. Okay, that makes sense. We want to cultivate relationships. We talk about it all the time. Okay. Here's another quote, and it's a more modern quote about modern day philanthropy, is donors are customers. It's not something we're used to hearing. The charities offer a valuable product, like a retailer, provide great service, hopefully like a retailer, and build a donor-focused approach, trying to get closer to the donor. Next slide. We can do the next slide. So donors are customers. Now that sounds like retail, and it is. We're in a retail business. We're a charity. We're selling our wares. It's retail. Maybe the community foundation is wholesale in between. So how do we do this today? We know there's internet fundraising is a way of doing things, and even artificial intelligence in terms of looking at people's needs and trying to find out who they are. But how do you do major gifts that way? Very hard. So it's relationships which make the difference, especially in terms of the internet fundraising that goes on, which is good, but doesn't sustain large organizations or other organizations that work in different ways. It's still relationships. Next slide, please. So the question here is strategic gift planning an answer to relationships? Okay, it's a little bit different we're talking about. When you're doing strategic planning with someone, you're talking to the donor. It's unique. You're building relationship. It's one-on-one. You're offering more efficient giving mechanisms. That saves the donor money. That's a service that you're offering, okay? Not just the charity content of what they're buying, but also to them, a new way of giving, which is helpful to them. Either it fits in with their estate planning or their tax returns or whatever. It's confidential. You're dealing with someone and you're doing confidential. You often obtain information that's quite confidential, which shouldn't go into your charity's records and all that kind of thing. You're developing trust. And that's considered to be the #1 successful trait of a fundraiser. Back, 10 factors of fundraising. Trust is the most important one. So even getting into someone's affairs a little bit engenders trust, and that's a key thing to fundraising. You need to do this administration, finance ability. You need a team approach to this, okay? And this, you're leveraging the charity and people around it for better service. So strategic planning can be a great answer to developing relationships if it is a process, not a product. And here's an example when I say, let's assume that your accountant comes to your charity and says, you've received $20,000. We've received $20,000 from the Henderson family. And they say, well, we're not sure. Is it from the Henderson family or from Estate Henderson? Okay. And the question, which I ask you now, you can't answer. That's why it's a little more difficult, this technique we're doing today with Zoom. But I'm asking you, is that a planned gift? Is it a strategic gift? And probably the answer says, well, if an individual sent the money in somehow, it's probably not a planned gift. Oh, if it's a bequest that came in, it's a planned gift. And the answer is absolutely not. We have no clue what it is. The answer is, has there been a process of development with the Henderson family, either leading to a will gift or whatever, a process that has resulted in a $20,000 payment some way or another? If there's been a process, then it's a strategic or planned gift. And let's look at the words strategic or planned. That's adjectives. Strategic, planned. Is there strategy? Strategy is not a product. Strategy is a process. A plan is not a product. It is a process. Okay. So the objective today is looking and saying, next slide, please. How do we move from offering products to offering a process? Okay. So with knowledge of donor, and you may only have some knowledge of donor, in terms of the process, you'll get more knowledge. How can you take that knowledge that you have, educate them on potential mechanisms of giving, okay? Not necessarily hitting exactly what they need, but with the intel, having an idea what could be, then saying there's different mechanisms, evaluate what's best for them, choosing the best, and all over time building the relationship, okay? So it's a different way of creating a relationship. The next slide, please. We know that when we look at the needs of charities and everything, it's a Venn diagram, right? From grade 4, the Venn diagrams, which say we're trying to find the needs of the charity, which can be capital needs, short-term annual needs, or long-term needs, okay? We're trying to find the needs of the donor. We're going to talk about that. It's not financial. Are they a repayer? Are they an analyst? Are they a leader? The needs of the donor, of where they're coming from, but also the financial transfer. How to put that together? That's got to be good for the donor and good for the institution. And so we call the financial transfer the plan giving part of it. Next slide. So, and the next slide, please. Okay. So just a couple of quotes. And the reason we put in quotes is it makes us sound so smart. We use smart people to do it for us. So the word as we have created it is a process of our thinking. Change. It cannot be changed without changing our thinking. So I'm asking you to change your thinking about how you appreciate strategic planning as a beginning process and not an end process. Okay, that the strategic planning is a way to develop relationships to get closer to your donor. The final solution will be somewhere there, but it's a different way of us thinking. We don't generally do major gifts this way. We generally come in and we only deal with the needs of the charity, and we don't think of the donor as we're talking. Okay. Yesterday I was clever, so I wanted to change the world. Today I'm wise, as I am changing myself. So what is this change here for you, sitting out there in TV land, of being able to say, I have to sort of change myself in a certain way to be able to deliver information, education in a different way to my major gift potential to get somewhere. We're inverting, okay? We're not just applying the needs of the charity when we meet with them. We're also looking at the needs of the donor. We're trying to do that Venn diagram together as we're talking to them. Next slide, please. So we look at it and we say, what's of value to donors? And it may be charitable trusts, private company shares, mining flow-throughs, marketable securities, and sometimes it's not so fancy stuff. Sometimes it's as simple as, you know what, you're to make a payment in January, why don't you make the payment in December to get the tax saving this year instead of next year? So it doesn't have to be fancy. It's just working for your donor. It's thinking of them, being conscious of them, of their needs, and saying what's best for them. Being a trusted advisor to them, okay? You want to create that feeling of relationship and trust, a feeling of expertise, that you have some answers and you have the backup people to give even more expertise. What does each of these things do for you? Getting trust, feeling that you're an expert, developing a relationship. Obviously, more gifts. But one of the key things to understand here is that, and we're going to do this for 4 sessions, is that just because you talk about a strategic plan doesn't mean they're going to do it. In fact, they often don't do it. It's not the point. The point is that you're trying to educate them as to the best ways. And it may not be for them, but they appreciate and they see that you're working for them, that you're delivering possibilities for them. They may go back and say, here's the check. Quite simple. Okay. If that check came as a result of a process, it's still a planned gift. Yeah. If it came on its own without you involving with them, it's not a planned gift. Next slide. So to do this, you have to be a learner. Okay. And you know, we talk about learning institutions and things. That's what's happening today, is that wherever we're involved in, whatever retail, anything like that, is the people are learners. The retailers are learners. They're trying to learn, they're trying to pass on information. We have to be constant learners. We have to be able to evaluate possibilities. We have to use lay people properly, do it properly. We have to learn how to use allied professionals properly. When you learn, the benefits are terrific. Not always evident, but it's there. The philanthropic review, in essence, is the culmination of this. is to be able to work with a donor and to say, let's go through your review of how best to give and work through it with them based on their facts. It's an opportunity for the donor, but an opportunity for the relationship to get better and better. So effectively, you move from being solicitors to teachers. You're spreading knowledge. I'm amazed at how many institutions, obviously this is done one-on-one, but how many institutions do not offer giving courses to their list of clients, donors? Why not have an annual seminar where you're inviting your donors to talk about ways of giving? That will bring up people that you don't even know. Okay. Again, you're talking about helping them. How many institutions that are in the business of obtaining millions and millions and millions of dollars annually of giving don't offer to their donors structured ways of giving, at least educating them? Next slide, please. When I started, I had a number of ideas, and I put together a list of slides. And what I tried to do is take those slides and meet with either professionals who are influencers or donors. And we just tell the story of, we had someone, a layperson in the community who would call up people and say, hey, do you want to learn a little bit about the giving? I'm going to set you up with Bobby for half hour. He's going to do it with you. And I have a group of slides, and I sort of understand the donor a little bit, even though I don't know him. And I talk about the 3 or 4 things that may be of value to him. So this is what I'm challenging you with. You're going to get the slides, as you see. They'll be available on the internet, in the Pear Tree internet. I want you to take them over the 4 sessions and put together your own group of slides of things that you're comfortable with, so that you'll be able to, and if you're the nerd that can, all the fanciest thing in the world, you'll have more slides. If not, and they're more basics, that's fine, whatever you're comfortable with. So at the end, our end objective here, one of them, is that you'll be able to put together a small group of slides that represents your willingness to share with your major gift people. Yeah. So this is going to require change. So now we have the poll question. Laura, let's put the poll question up.
Do you see the poll question there, Bobby?
I do not.
Okay, just 1 second. We're just having one little technical glitch there.
I do see it now.
Okay, so it's there now. Okay.
And they can hear me?
Yeah, it just doesn't seem to be recording anybody's things today. But you know what we could do actually is, if audience, if you don't mind, if you can go in the chat window, and if you could answer the question, is it possible to change? Yes or no? If you could put in the chat window your answers there, that would be greatly appreciated, and we can have a discussion based on that. So Bobby, as you can see in the chat window, it looks like a lot of people are saying yes.
Fools. Okay, so let's go on, and let's put the next slide up. So if I talked about this philanthropic review, and we're going to do this in detail as we go forward. If I'm trying to deal with someone, I'm trying to determine where are taxable incomes. That's information. That means, do they have an operating company? Do they have a holding company which owns the operating company and other things? Do they have a personal tax return which has income? Is there a spouse that has income? I'm trying to find out where the action is. Okay. This next big question, again, we're going to see a separate slide on this, the next one. Is estate gift planning advantageous? So we're going to see this, we're going to study it. That's a question that says, I'm trying to read their situation and determine where are they from an estate planning situation? Are they going to have lots of tax to pay at death? Well, that may lead us to certain solutions. On the other hand, they have lots of assets, but they will not have, we'll see why, estate planning problems. Oh, that may lead us to other solutions. Okay, so again, this is the structure. We're trying to learn. We're trying to guess ahead of time by understanding the donor, which we're going to do in 2 minutes, and say, I think we know where we're going. Through discussion, create more knowledge and opportunity of what could be, and then look at the different mechanisms with them. Okay, that's appropriate to them and get to the right place. Okay, so the first part is let's look at donors. So let's look at the next slide. Okay, and we're going to look at 8 donors today. Okay. I've chosen this not because they're real and not because it's particular. They're actually representative of 8 types of donors. Maybe you're going to, in your questions later, ask about another sort of category of donor that I haven't thought of. But this is what I've sort of put together as templates a little bit. I want to find categories of donors and replicate. So in other words, if I have an idea of this kind, I know what I can use for others. So I'm just going to run through and then we're going to go through one by one. John, age 45, is a partner in a law firm, makes good money, maybe in a company, because some professionals put their money in a company. Mary, age 60, has a successful marketing company. Eric, age 55, is a well-known money manager. Bobby, age 73, built a successful lumber company. His children run the company today. Next slide. June, 89, is a widow. Her husband built a tool business, now run by the children. It's an interesting person. Lots to do there. That's a little bit different. Jane and Sam, both 82, are retired. They're Palm Springs snowbirds. No children. That's going to be interesting too. Dev, age 40, has brought his company public. The shares have gone wild. Ooh. Linda has reportedly sold her business to a private equity firm. Okay. So let's start going through this one by one and seeing where we go. Okay. So next slide. Okay, so let's talk about John the lawyer. And it's not just about John the lawyer. So we would profile him, and this is gossip a little bit, we're not really sure. Well, he's got a good name. He's in a good firm. He's a partner. Boy, these firms are doing well today. These mergers and acquisitions, they're doing well. He's probably earning a very large amount of money. Good for him. One of the things that when we look at, doing major solicitation is we want to deal with people who make a lot of money, who have a lot of money, right? We want to be able to get major gifts. So we like John. He makes a lot of money, we think. He's at an age where he also spends a lot of money. He bought the beautiful house. He's got probably a nice mortgage. Thankfully, mortgage rates are low. He drives a beautiful car. Kids are at private schools. He's got the place up north. he's got a big lifestyle, dresses beautifully, big lifestyle. So not only is he probably making a lot of money, he's also probably spending a lot of money. So when we think about someone like that, we say, here's a profile of someone who probably has not built up a lot of investable assets yet. He's starting to, okay? He's probably spending money, he's doing very well, paying a lot of tax, and spending a lot of dollars. So I'm trying to say, what kind of category do I see of that? So I'm saying, I like to find interest in something that can give him a gift, can leverage his big personal tax return that he has, okay, and not cost him a lot of money. So knowing, and let's assume we're meeting John because we have a campaign and he's known and he's affiliated with us and we're meeting with him. Okay. And we want to talk about the needs of our institution and everything like that. But if ultimately we want to get, let's just say, $150,000 gift from him, payable over a number of years, this campaign, we might show him an example, not of John, but of an example of someone who can take advantage of mining flow-throughs. We're going to talk about mining flow-throughs, what they are, what they do, the whole thing. So don't worry about the technique now. But we've already thought in the process that this person could be good for that. We need a nice personal tax return. He has it. He probably wants to save as much money as possible on his gifting because his cash flow is tight. Okay. So here we go. And I probably present him not something that says John, like someone else, showing how someone can make, let's say, a $30,000 gift per year for 6 years, $180,000. How someone has done this by buying mining flow-throughs each year, cost of donation 4%, whatever it is, type of thing. That means $30,000 is $1,200 out-of-pocket cost for 6 years. I'd like to show them a spreadsheet of that. Here I am, I'm talking to him about the needs of the institution, and yet I'm showing him a way to give. I'm not saying you do it. I'm just saying, here's a way of giving that some people have done. And in this campaign, we're going to show it. Now, then you see how it goes. We're educating him. He may have heard about this, but we're really educating him. He might come back and say, that's really interesting. I wonder if I could do that. And you might say, you know what, we can do this chart for you based on, more information, just to say what you could do. And he might give you more information to be able to do a chart. Again, we're not selling the mining flow through. We're not picking the company or anything like that. We're just showing him an illustration of how it works, type of thing. Well, that's another meeting. You come back with that. So here we have somebody, John, who we want to get closer to. We're using the discussion of the institution, but also the discussion of a plan giving and strategic plan methodology to get closer to him. We're not closing the gift at that first meeting or second meeting. We're working through with it. Okay. Now, John's not just John the lawyer. He represents, in this category, executives of major companies or private companies, executives who pull down big earnings, salaries, other items on their personal tax return. So you can envision someone that you're dealing with in your campaign that's got a big personal tax return, okay, probably does not have investable assets yet, which may lead to other potential gift mechanisms. Well, there you go. We can do this technique and this categorization of John for a whole group of people. Okay, let's go to the next one. Marketing Mary. There's so many marketing Marys out there. age 58, 60, 56, 63. We know Mary. She's had a brilliant marketing company out there. Probably has done very successfully, done very, very well. I would venture to say she's had this company for many years. She's done quite well. She probably has, I'm already trying to identify, I don't know. She probably has her ownership of her shares through a holding company. We're going to be talking about companies. We're going to have a primer on companies in session 3, but she probably has a holding company and an operating company. That's what we have in Canada. We're going to find out why later. So once I have that in mind with her, I'm saying, whoa, that's information. Not sure yet, but that's information. That's important. Okay. That may lead me to certain types of gift conversations with Mary. Certainly, when I talk about that question about estate planning and say, well, Mary's got a company and a holding company, which ultimately, when she passes away, her and her spouse pass away, there'll be tax to pay. So I'm also thinking, depending on where the gift is going to go, of how I could use that to my advantage. Because, yeah, ultimately there's going to be tax. And she's probably at the age, maybe she's done it, maybe she's thinking about it, where she's going to do some estate planning. May do freezes with her shares. So children ultimately will get the future value of that. We're going to look at this. So all of a sudden, if I know this person, I don't know them yet, but I can have an idea of them, a category. I can start thinking of possible gifts. And now when I have my slides and I visit, I'm saying, okay, if she has a big personal tax return, I can talk about mining flow-throughs. If she's going to have in her holdco a lot of assets that she's reinvested, she may have great marketable securities there. I may want to talk to her about that. I may want to talk about insurance to her for an ultimate sort of legacy gift and do it in a way that we're going to learn. So I've sort of identified where I could possibly talk to her about. And she'll be interested to learn some of these things. You'll be interested too when we see them. Okay. It's not going to be very technical to learn these things, but you'll be interested, but she'll be more interested. So we're going to get closer to Mary. Let's look at the next one. So Eric Money. Eric's a broker or money manager. We think he does well. There's a following for him in the community and whatever. He's done well. So there we go. And he's built up a good practice, and he's probably making a fair amount of money. So again, we're trying to look and see where that person can use planned giving. If that income's on his personal tax return, we have mining flow-throughs. If he probably has his own company and earning money through the company and reinvesting, we may have marketable securities. Probably what I found is that when you deal with people who deal with marketable securities all the time, they tend not to look at other things. They have to look at their personalities. They know that. They feel that that's the best way to go for people to donate and for people to do things. So I'm going to focus a little on there. But I'm also going to talk to Eric about trusts. He is not going to do a trust. You're going to see why trusts are important, how fantastic they are for a certain category. But he's an influencer. He's got clients. Okay. So when I'm talking to him, I may bring up things that he could use with his clients. And a chair remainder trust for the right person is a great tool. And he probably has clients who could use a chair remainder trust to benefit your charity. Okay. And he could run it within his practice. In other words, the money can stay with Eric to manage. So it's a fantastic thing for him that he's going to help his clients Okay, at the same time, not helping himself, really. So when I see Eric and I want to talk to him about the campaign, I may throw in some other ideas that can help him as an influencer bring in results for you. Okay, categories of people. Next slide. So this next slide is Bobby Wood. Okay, so Bobby's got that lumber business. His family already runs it. It's been successful. He's a major player. Okay, I think we said he's 73 years of age. He's, again, the children are running the business. He's a big shot. Okay, he's very successful. So without question, just like Mary Marketing, we're going to think that he has a holding company with loads of assets in it. We're going to find over and over again that Canadians of wealth from businesses have holding companies. They do. That's why it's important for solicitors to understand that, because that's where the money is. Okay. He's in a state freeze. We don't know that. He probably at 73, he's probably done it. His children are in the business, so he's probably done an estate freeze. He has perhaps big RSP income that he's past 71. He's taking big RSP income. So here we have another kettle of fish, similar to Mary, a little older. Okay. He probably he's closer to that age where estate taxes could be an issue. Okay. He's 73. He's certainly not gone. He's still relatively young, but closer than Mary. He's 58. He's 73. He's got to be thinking about that, or could be thinking about that. So the insurance mechanisms and different things like that. Maybe we start looking at gifting from his company or gifting shares of his company, because he's going to be there. He could be there. He has big personal tax returns with RSP income, maybe mining flow through shares. Okay. Marketable securities from his company. We have a number of options here. So again, when I'm meeting with him, this is the traditional way of saying, let's talk. I want to show you different ways of giving, simple ways of giving, and whatever. That's part of the solicitation. We're not asking him for money. We're part of the developing relationship. We're in a campaign. We're not just walking in there and saying, please give me money. It's this is what we're doing. This is the campaign. We'd love for you to be involved with this. Can I show you some ways of giving that are interesting? Okay. And start having discussions. So in some ways, if they start looking at that, if they are interested in that, they're almost saying we're going to give, right? Because if you're starting to talk about the ways of giving, sure, you have to work on the philanthropy side, a lot of work on that, but you're starting to create a mechanism of how to do it. You're helping say yes. So Bobby Wood is a tremendous group of people in our community, business people. They're at the right age where they're wealthy, their children are set up, they can give tremendous gifts. It's a great age to deal with and a great person to deal with. Let's look at the next one. June Grandma. Well, this is going to be a favorite of mine because I guess I'm a grandpa now, so there we go. So June Grandma. So June Grandma is a widow. She's about, I think, 89. She's with it. She's with it. Okay. So certainly, again, she's sort of Bobby Wood's husband, 15 years later type of thing. Bobby's passed away. Okay. She's inherited a lot of value, holding companies. Maybe there's shares of the business that the children are running and doing everything like that are still there. She's got lots of income from RSPs and everything. She's comfortable. She's got a holding company. She's got estate taxes that are looming now. She's not 58 where we're starting to think about it. She's not 73 when we're closer to it and we want to think about it. We're 89. We have we have taxes that are going to come. Yes, it may come in the next 10 years. So we certainly have ideas here that are really terrific for her that we could show. And with an 89-year-old, it may be difficult, but as you talk, you may say, hey, let's bring your children into these discussions. Okay, of them helping because then it's going to have to come with the children, and you're meeting with the children and her, or one that can help. And again, you're educating. As you see on the slide, I've done some asterisks because making a marketable security gift from Holdco is tremendous as a planned gift. It's not just good, it's tremendous. There are reasons for her to give preferred shares, which can be tremendous for her. We're going to actually see this in a few minutes, because that's when I said at the end, we're going to do a taste of things. This is one of them. We're going to do a taste. Okay. How to do a will gift with her. Okay. That's a norm. She's at the age, okay, where now it's now or never. But some of these thoughts of will gifts, when we look at our planned giving, will actually move up the gift while she's alive. Okay. That's some of the things that we can do by looking at strategic giving. Okay. But this is called communication. It's called trust. It's called relationship. Okay. And trust. Let's look at the next one. So Jenny and Sam are of that age where I think they're 83, very with it, where they're not going tomorrow, but they've got to think. They have really nice assets. They've got a nice estate. They have no children. So we're going to look at this. You're going to be sick of me talking about charter remainder trusts. Okay. Because we're missing. Canada's missing out on this. The charities are missing out on this. 25 years ago, it was talked about and things like that. It came up from the States and people talked about it, but we're not doing it. And it's a great opportunity. It's a great opportunity because when Jenny and Sam pass away, they have an opportunity to give all their assets or most of them to charity. And at the end, because of that, they're not going to have estate taxes because they're going to have such a credit and deductions. They're not going to have any estate tax. In fact, their deductions are going to be so great, it's a waste. They may give away $3 million to charity and use on the final tax returns $500,000 of that charity receipt, making $2.5 million useless. So the charter remainder trust moves up that receipt while they're alive. Okay. It's still the income from those investments will go to them. So they're still living off it and everything else like that. Doesn't really change anything for them, but they're saving tax today. It's a gift. So it's a big opportunity. Why it's a big opportunity? Because you can help them do this, but then you can get the entire estate, relationship close, what you're doing and things like that. You have a chance of getting $3 million from them. Okay. And a good chance once you have the relationship and you're performing for them. Next slide. So DevTech is that person who's taken the company public and, call it a high-tech wonder. And every community has these now. Beautiful. They're fantastic. And it's a new wave. And where people used to be, 50 and 60 when their businesses are tremendous and whatever, and are able to do things. Now, all of a sudden, they're 30 and 35 and 40 and 45. And all of a sudden, they're worth amazing amounts of money because their shares that they have are worth amazing amounts. So we want to deal with them. Okay. And again, like our 89-year-old woman, if I'm a holdco where I have 4 asterisks there and say that's terrific for her for reason, for Dev, there's also a reason here, which is fantastic. It's close with the reasons, but of course they're different ages and there are different needs and things like that. So we have an opportunity and we have to look at it and say, they have amazing amounts of shares with a low cost base sitting there worth gigantic amounts of money. They may not want to sell them really, okay? But how do we work with them? Because if they have that kind of value where their shares are going up and, all of a sudden, they were worth 10 million and they took it public and now they're worth 90 million, and maybe in 3 years it's going to be $1 billion and maybe it's going to be 5 billion. Let's get on the bandwagon with that person. And we're not just interested in trying to get every dollar today with them because the potential is so great to build it. So this is an interesting thing. We all have these people in our community which we want to bring into our campaigns, and we have to talk about our institutions and what they do, what they care about. But let's try to bring some product to them and understand them that can help them. So next one. So here is, we call this Linda transaction. And I don't know what the right term is, but I've always called this the transaction. And I define them of people who have had maybe a once in a lifetime. They're not once in a lifetime, but they've had major dispositions. Okay. It's all of a sudden someone that sold a lot of real estate. And today that's gone on in the last year or so in Canada. There's been amazing sales of real estate, and with large gains, and that's a transaction. Okay. People selling businesses. There are a lot of business sales going on. Our mergers and acquisition lawyers are John the lawyer, age 45, is dealing with a lot of these today. Private equity firms are buying in. There's loads of private equity coming around. They're buying into companies, and they're just sales company. So this is a big deal that's happening right now, and it's quite remarkable during the pandemic how much action there's been on this. So once we know, and we've heard that Linda has got this, we want to be able to meet with Linda on behalf of our campaign, but we want to be able to show her some ideas that can go on. And we're going to talk about cumulative preferred shares in our last, our third seminar, being an incredible gift in a certain way. We want to talk about marketable securities that they may own to offset tax, DAF. So I'm going to bring this up over time. You charities out there, one of the things that you could bring to your donors, increasing relationships and things like that, is by adding a donor advised fund to your charity. I'm not talking about doing a community foundation where you invest it all and things like that. But for example, when we talked to John and we said, we want you to do $25,000 a year for 6 years, buy a mining flow through if you can, to put through $30,000 of donation, and you say, you'll give us the $30,000, but there's 5,000 extra there. Just tell us what donations you'd like us to send around the community for that 5,000, and we'll do that for you in your name and everything. So you're trying to get closer to them. Again, you're not investing the money and setting up an account. You're saying, we have money for you. Just tell us when, and we'll write the check from our institution to the charity that you want in your name. So I want to bring the concept of donor advised funds, not to set up a community organization. Maybe you will in some ways to get really close to your donors. But I want to bring this up to your charities of saying, give a little latitude when you're talking to your donors about what you do for them, what you can do. Because certainly when you're doing mining flow-throughs or marketable securities, when you're taking advantage of low cost basis, and if they're going to give you $50,000 when they're doing that, of low cost base marketable securities, if at the same time they can do a little more to help their other charities, that means they're bringing low giving costs to their other charities as well. And you are helping them do that. Help them do that. Be donor focused, be donor friendly. You'll be trusted more. You'll get more money. Okay. So here we go. Next slide. What is most common to a lot of our discussions that we've had here? You're going to talk to me, and I already see someone talks about farms. Farms are like companies. Okay, they're often in companies, by the way. Okay, and there's certain things we're going to look at. For example, there are some of the plans that we're going to see for corporations, which involve farms and small companies, involve something called super capital gain exemption shares and giving them. We're going to get to these things. But so much of what we've seen, except we haven't said, you know, our Palm Spring people, most others have some company around them. Even the lawyers are earning money through a company. Canada's very special about companies. It's very different from the States. Very different. It's very different. And so their processes and techniques, and Charities Trust is their biggest plan giving mechanism, not for us in the same way, okay, takes into consideration that they own their assets personally, and we don't. We own through holding companies, etc. United States has companies that you work with called S corporations, where the income comes onto your personal tax return. We don't have any such thing. We have integration. We have other things. We're going to learn about it. So we have companies, and that's why it's so important to learn about companies. Next seminar, we'll focus on, as we saw, marketable securities and mining flow-throughs and charities trusts and other things, not necessarily corporate things. And then the next seminar afterwards, we'll look at corporations. So it's going to be very important. But before we get to the next seminar, I want to give you a taste of a couple of things. So let's go to the next thing. We're going to come back to June Grandma. And this is technical. I promise not technical. Here you're going to get stuff. We're going to learn it later. But I want to give you a taste of what we can do. We're going to do June Grandma and Dev, the public company, new public company guy. So June Grandma has a holding company. It's got lots of assets in there. In fact, there's $5 million in there. She doesn't take assets out of there. She's got other assets. She's got RSP. She doesn't use it. It's sitting with money she doesn't need. Okay. She's not giving it all to you, but she doesn't need. The value of that holding company is $5 million. When she passes away, again, her husband has passed away already. When she passes away, she will be deemed to dispose of that company for $5 million. And assuming there's no cost base to it, that means she'll have on her final tax return a $2.5 million taxable capital gain. And assuming a 50% tax bracket at the high rate, and of course, in some provinces are higher, 53 and things like that, but let's assume 50%. You have a $1.25 million tax liability. Now, we have different plans that we're going to see to mitigate that. But here's one. Let's assume that she has her company and she's been holding stock for a long time. So here she's sitting with $1 million of, call them bank shares. And she's been sitting with them for 30 years and the husband is sitting on them. And the cost base is $200,000. Okay. Let's say she donates it to you. Okay. Great, thank you. What happens? So the usual part is, okay, let's get a receipt, use it if we can. We may not be able to, but let's do that. What else is happening here? Her holding company that was worth $5 million just lost $1 million. It's gone. The company's now worth $4 million. So if she were to pass away after this gift, all of a sudden, her deemed disposition will be at $4 million. Her capital gain will be, taxable capital gain will be 2, and she'll pay tax of $1 million instead of $1.25 million. We've just saved $250,000 of tax by this gift, not directly, indirectly. There's more. We have in the company a disposition of the shares at $1 million, $200,000 cost base. There's an $800,000 gain. But we know, thankfully, that when we give to a charity, that gain gets eliminated. There's no tax. Fantastic. More value to her. But we also know when a company does that and it doesn't pay tax on something, and we're going to look at this. Don't worry if you don't quite get it. We're going to look at this later. That gain that's not taxed goes $800,000 goes into the company's capital dividend account. There's no such real account. It's not a bank account. It's just a number. There's $800,000. What can we do with that number? We can pay out a dividend to the shareholder, June, of $800,000 tax-free out of the capital dividend account. So we've made the gift. The day after, $800,000 dividend goes out to June. Fantastic. We've now, she has $800,000 of cash for herself. What's happened from that deemed disposition at death? We started at 5 million. We gave a gift of $1 million. The company's worth 4 million. The next day, we passed out $800,000 of tax-free money. The company's now worth 3.2 million. So if we pass away, we're deemed to dispose of the company at 3.2 million. 1.6 million is taxable. 800,000 is the tax. We started at paying tax at 1.25 million. By making the gift, we saved $450,000 of estate tax. Wow. And I mean, wow. Because once we have this and we start to talk about the possibility, you're going to have to bring in their professionals. We're not doing the plan. But when we talk to their kids about ideas of planning that they can do this, we're taking, instead of trying to get a gift out of at death of them, the money's coming today, but there's a lot more. We can look at the entire $5 million. We can develop a strategy that maybe she's going to sell some of her shares in the company, create more capital dividend account, use the capital. She'll have capital gains, but the gift will offset the tax on that. You can probably put together a plan that the whole holding company will be gone. So we'll eliminate the $1.25 million tax. We may be able to pull out $3 million of cash, of assets to her. And the remaining assets, $2 million, may wind up with you. And the net cost of all of this could be much mitigated and reduced by saving all these taxes. So that's what I call as a taste, is when you start to look at people and where they are and look at them as who they are and understand them a little bit and start to talk to them about ideas, then bring in family, their professionals. You're not going to put together the plan, but show them what others have done. You're starting to get into a different relationship and different discussion and different giving. Okay, so let's look at Dev and the next slide, because I want you to give a little taste. Dev is fantastic. Well, I've had the pleasure of seeing some of these, call them high-tech wonders, just in the last year, work with them. Sometimes they're arrogant because they're the masters of the universe, right? They've created something and they're worth $1 billion all of a sudden, and they're worth whatever. They're entrepreneurs. The values are incredible. They may not have all that money. They may how to get the money out type of thing. The sky's the limit to them. No, the sky is not the limit to them. The sun is the limit. They've gone past. So working with your organization, they're a different kind. They're usually analytical. We're going to see different styles of givers, analytical repayers. They're usually analytical. They want to see return on investment. Okay, that's how they've run their company. and they want to see that from you. You've got to deal with them in a certain way about what they could do, what good they want to do for society. They want to get involved in some ways because they think they know better. Okay. But they're also in an interesting place financially. So I'm just making this up here. Dev wants to buy a $2.5 million condo, which is where I am this morning in Toronto. Will get you about 50 square feet. But let's say they want to buy a condo, and he wants to take out, he needs $2.5 million. So he's got his holding company. Again, he does have his holding company. Amazing. In all of these, they're owning their shares through a holding company. And again, he's been successful as a businessman. He's got assets in that holding company. And he says, okay, I want to take out $2.5 million. And, oh, okay, so if I declare a dividend from my company of $4 million, and I'll pay $1.5 million of tax on the dividend, I'll have $2.5 million, and I'll buy the condo, right? You shouldn't need to get a mortgage or anything like that. Okay. So just playing with him. Let's assume he gives $1 million of his shares owned in the holding company of his company to your charity. Okay. And I'm going to talk to you about what to do with those shares in a second, because you've got to think differently here. Okay. So what happens on that? These are shares that were once his private company shares. They got converted into the public company shares. They have no cost base. So when he does that and he has a disposition to you, there's no capital gain. All the $1 million is the gain that's not taxed. It's going into his capital dividend account. He could take out $1 million tax-free. Let's just assume, I wouldn't necessarily do this, that on the market, he's not going to do this. He takes $3 million of his other shares. Okay, maybe other companies, but let's say even of his shares. And he sells them in the company. So now he sold $3 million. There's a gain of $1.5 million taxable gain. So he's $1.5 million of taxable gain. He's going to take the receipt of $1 million against that. And he has $500,000 of income to pay tax on. Let's assume he pays $250,000 of tax. We won't let him, but let's assume he pays $250,000 of tax. Okay. From the sale of $3 million, half of it is taxable, half of it is tax-free. So he has $1.5 million, which goes into that capital dividend account. $1 million from the gift and $1.5 million from the sale. He has $2.5 million now in his capital dividend account. The company makes that dividend to him of $2.5 million, tax-free. It doesn't have to make a dividend of $4 million, right? It can make a dividend of $2.5 million. And now he has $2.5 million to buy the condo. In essence, what he's done is he's paid, in our case, $250,000 of tax. And effectively his cost, he's paid $250,000 of tax. He's done a gift of $1 million. He's done that. His total cost of doing this with the gift of $1 million, his tax of 2.5, his capital dividend account of 2.5 is 3.75 million. In other words, their 3.75 million is gone. Okay. If we would have done the dividend of $4 million, $4 million would be gone. So we've now done the same thing for him in terms of what's out of pocket, and he's given $1 million. Now, again, I may do this differently, and we may do things differently and things like that. The idea here is to have a conversation with Dev in which you actually have slides on the table, which talks about giving shares from his company. Okay, and the effects of that and capital dividend account and the ability for him to do that. But I want to tell you something when you're dealing with Dev. This is a long-term play. Just because he's giving you the $1 million, he may not want you to sell it. Okay, he may want you to hold it because in his mind, that $1 million of shares, it's going to be worth $5 million. Okay, And therefore, if you hold it and it'll be worth 5 million, you get 5 million and more, because he's going to be dealing with you forever on this. So you've got to think of your donor. They don't want to sell their shares. And I've dealt with some recently. And we've done in one gift of a fair amount of tens of millions of dollars of shares, but don't sell them. Okay? Don't sell them. So you've got to think differently. You've got to think of your donor. You've got to think of where he is psychologically, doesn't want to sell his shares. Okay? Because to him, they're going to be worth much, much more. So you've got to know your donor. You've got to talk to him. You've got to get close to him, put the ideas in front. And then as you're talking, whatever, the ideas will percolate with his advisors into a plan and in a relationship. And you might have with Dev a relationship that's going to lead ultimately to $100 million into your charity. That's how it happens. Okay. You may look at stock options with him. You may look at different things with him, but it's all there for the taking. We've just got to start thinking of corporations, how they work, what are the opportunities. And someone just said, how do you, if your organizational policy is to sell the shares, well, change your policies. If you know, that's just a policy for certain purposes. See, we have to get out of our, can we change? I've dealt I've done consulting with charities that says, oh, but we have a rule that says we sell them. Of course, we always sell them. But if you're dealing with someone like this and you're getting close to them and you say, no, in this case, we're going to be holding on to them. So you've got to get in your gift acceptance policies, you've got to say when you do this and when you get permission to do it. Okay. The policy is just for you how to do better. If there's a better policy that says, yeah, generally when people donate in, yeah, you sell the shares, you turn it into cash, you put them into your investment mechanism. But if you've got a relationship that's going to build upon something, do that. And, I can think of one person, his name is Aaron. Years ago, he gave us $1 million of shares and I bet with him. I said, I'm not selling them. Now we were going to spend 5% a year. So what we did is every year we would compute 5% and sell 5% of the shares. The shares go up, but we would sell that number to get us the cash for the thing. That's one way of dealing with, a charity that you want to spend on. And the end result was I bet with him and he knew I did. And the end result a few years later is a $19 million gift with his 3 partners, because he was part of the family. We were betting with him. We were thinking of him. We were giving him the best tax treatment with the capital dividend account originally out of his company. And we were part of the family. And we were working with him. It wasn't about us. It was about him and us. So the question about, oh, but we have a policy. Okay, we're going forward. Can we change? Can we look at our categories and say, if this happens here and we get in with how many of these people are there in our communities, right? A handful, right, at a time. If we deal with them, well, we might have different policies for them. And we have to prepare ourselves. We have to do gift acceptance policies. So we're going to do questions now somehow. Our next seminar will be a week from today, 10:30 Eastern Standard Time. Thank you. But now I'm going to be questions, or Marilyn's going to come on, I think, and we're going to talk some questions.
Great. Thank you, Bobby. Certainly, many of us know you as the executive director at the Jewish Community Foundation, but
I was.
You what? Former.
Is the executive director of the Jewish Community Foundation, and she's, our wonder.
Right. But what some of us may not know is that you were a partner in taxation at Ernst & Young. And so what you're bringing to us is really a culmination of both careers today.
Well, I'm just saying that when I started in the business in 1994, and I just gave a speech recently about this, is I got an American tax planning book. Okay. And in the summer before I started, so I gave my notice from the firm on April 1st, and I was leaving August 1st. In that interim period, I got an American tax book, a gift planning book, and I tried to see if I can Canadianize the ideas. And a lot of them were out there. They were out there, and a lot of them were unique at that time, and now are out there, type of thing.
Mhm.
And I had 11 ideas of doing it, and made slides of those ideas, and then started to visit people with them. So, and I'm not suggesting people watching this are me, because we're all ourselves. We have to have our comfort level of what we do. And that's why I'm saying I want you to build your own slides. And it could be on marketable securities. It could be on mining flow-throughs. It could be the simple one about dev, not the technical one that I could have done, but just simple of saying, if this happens, you know, your capital dividend account, and understand that what you can explain and take it to your level, but have that, practice it with your confreres. And then when you're talking to people and at the right time, you're saying, hey, I want to show you something. I want to show you how mining flow-throughs work.
And I love what you said about the fact that by the time we get to this conversation, we've already talked about the cause. We've already got their commitment and interest in the cause. And so that legwork has been done. And now we're moving into a different conversation.
But I'm actually saying part of the legwork has been done. You're talking about the cost, but I want you to bring in this stuff before you're finishing selling the cost. Okay. I don't want you to say, oh, I'm ready to do the gift. Now what do we do? I want this discussion of us helping them to be part of the process of them helping the cause. I want to marry their needs and your needs together as you go forward and you have discussed. I want you to create trust with them. I want you to, before they decide to give you that $100,000, okay, I want them to think that you're working for them.
Right.
Okay.
Right. And then we might be at a $250,000 gift.
Right.
Right. Yeah. We've got some great questions. You've intrigued a lot of us. We're going to work our way through a few questions and see what we can get to. We recommend that people do attend all 4 of these sessions, and that today's session is being recorded and will be sent out on Thursday. If we don't get to your question, please don't hesitate to email your question to askbobby@peartreecanada.com, and we'll make sure that we work our way through using that form.
And the slides will be on the Pear Tree site.
Yes.
To download. Right.
Yeah, absolutely.
And the only value of these slides today, or not much value, is take down those 8 categories. Like you might say, and what are my categories? Let me sort of work through the people I work with, and maybe you'll send an Ask Bobby question to say, I have another category. Can you please talk about that? And I'll write up a thing that everyone can see about how I see that category.
Sure. Yeah, absolutely. Laura, can we see a couple questions?
There will be some at the bottom of your screen in the Q&A icon, but I do have some here that I could actually read to you too, and I'll just start you off. It's one here is, if the donor is younger than 35 years of age, would you use a different process or tool with this age range?
Well, you know, your category is your category. So 30 is 30. Why, you know, so I've used 40 in my example with Dev. I've used 45 with John. 30 is the same. Okay. If they're in the category of a major gift person, okay, at age 30, right, you're seeing them because they're able to do, okay. So the 40-year-old, so probably like John, they're doing very well. They're spending a lot of money. That's there. You want to just define who they are. If they have a big tax return at age 30, and they do, hey, you know, John at age 30 was a partner in his firm. So he was making a good living. Maybe he's making more now, but he was making a good living. So mining flow throughs could still be good for the 30-year-old with that big personal tax return. If he's a high-tech wonder at age 30, it's the same if he's a high-tech wonder if he's age 65. They're not worried about estate planning at this time. They see growth, and they see potential, and the sun's the limit, not the sky's the limit. So it's Dev, except they're 30. Okay, of thinking of long-term gain for your institution. The 30-year-old's got something. There are institutions in California, charities, that look at the startups right? And they go speak to them and say, I'll say Stanford, don't quote me, whatever, and say, hey, why don't you give us some of these beginning shares as your gift to us? Okay, they're not selling the shares. Okay, they're starting, you're going public, and there's these shares. Why don't you give us some of that? They may cash out a little bit to use the receipt against that, but let's do that. And the intention is not to get the $10 million worth of shares. That's what or $1 million. It's that will be $100 million one day, or zero. Okay, or zero. Oh, but we've lost $1 million. It's okay. You never had it to start with. And that's what I've had in an institution. Well, if we do this, we've lost $1 million. You have nothing. Okay, here you're working with someone, put it into the hopper, the $1 million of shares. You're not selling it. You still have nothing. You're no better off or worse off, but that could become 10 million, 20 million, 30 million, or maybe it'll be $1 million 5 years from now when you do cash it, type of thing, because it hasn't, and that's what it is. But we're thinking, what's about that donor, the potential, the 30-year-old can have a potential of $100 million. Let's try to get into, let's bring him into the family and excite him about charitable stuff that can be done with it, using his analytical brain of what can be done either in business or whatever it is.
Right. And I know we've got some follow-up questions from that idea, but let's go back to an earlier question. How would you approach a farmer? You got into it a little bit, land and company worth a lot. And when they retire, they'll make a bunch of money, but how is a farmer different?
So a farmer really isn't different. It's a business person. Okay. There's an opportunity for tax for them, but a farmer is a business person, right? So if they're at the stage of having a major gift, and I was lucky enough to work on a plan for a farmer who's brilliant, right? That I was so lucky to be able to work on a gift for an institution that turned out to be $15 million. But we did it with preferred shares, and we did it with different ways. It was a different gift because of what he had. He's a business person. So the only thing I was talking about before is that small business companies and farms have the opportunity to sell their small business or farm and get a certain amount of capital gain exempt from tax. Okay. And what happens is that when this legislation came out, many professionals started to go to these farmers and successful ones and small business and said, hey, we may not qualify for this when you actually sell, because there's such rigid rules, but you qualify now. Why don't we create an artificial gain? Okay. We'll take the exemption. We won't pay tax on it, but at least we'll have built up our cost base of our shares now. And those are called super capital gain exemption shares. And they are there for farmers and for small businesses. And we actually have one little plan that when you have these shares that you own now, okay, that you donate them to a charity, and the charity then, the company then redeems the shares for cash. And it's a very good tax mechanism. We will look at that in a few times. So I'm saying that's good for farmers if they have that. But otherwise, a farmer's a businessman and has the same rules as anyone else. And we treat them like anyone else, I think. But I don't have a lot of experience with farmers. Again, I helped one institution, another institution do one. It was a very major gift, turning what was originally going to be an ask of a few $1 million into an ask of tens of millions of dollars. And we found the mechanism, again, looking at his holding company and estate taxes and saying, why don't we start giving gifts of preferred shares, which we redeemed. Okay. And again, you may not be able to get involved with that, but at least talk about the possibilities so that they can go and work with their professionals to get there.
Okay. And when do you advise that we, as the fundraisers, if we're looking at it through that lens, when do we call in the accountants and the lawyers or advise our client or our prospective donor to bring them in?
Immediately when we talk about these ideas, we say, oh, you should, if these things look to you, we can supply from it, but please speak to your professional. At that, anytime you're showing a possibility, oh, there's capital dividend account, please talk to your accountant about that. Mm-hmm. So, because two reasons. One is there might be something particular about them that we don't know. that's not evident, that really that it will mean it doesn't work. For example, if they sold a in that when we think of June grandma and we say, oh, we're going to give a gift of $1 million and create capital dividend account. If for whatever reason she had sold securities earlier and created a loss, then she has negative capital dividend account. And therefore, when we create capital dividend account, it may not help us as much as we think. So there may be things that are there that we're not aware of, and they may not be aware of. So it's always speak to your accountant, make sure that you could do it with mining flow throughs for sure. If you have the tax return, speak to your accountant, make sure it qualifies for you and it does all that. We can help you with, here's a computation a generic computation. Here's a phone number to Pear Tree or something like that. But you know, we're not selling mining flow throughs.
Right.
We're not selling them. We're just introducing the concept to them, and it may not be appropriate for them. So let's not stand by it. Let's just say, please get your accountant. So anything we talk about, capital dividend account, charitable remainder trust, oh, let's talk to your accountant about doing this.
Okay. And Amanda has a great question on that same theme. How do you suggest we, as the fundraising world, the philanthropic world, build credibility to help donors see us genuinely as interested in bringing value and not just purely, you know, forwarding our own interests?
Yeah. By the way, is this Amanda who worked with on a charitable remainder trust with me? If it is, hi Amanda. Look, you're out there. You're a trapeze artist. When I talked about being circus performers, it's part illusion. It's part you're in a high wire act. You're out there. It's so hard. People think it's so easy to go talk to someone about bringing in a gift. I know how hard it is. You know how hard it is. Okay. Okay. So you just be honest. You just be showing that you care about them and what they could do. They will pick up on that. They will see that. And that's why I'm saying you're talking about your organization and what their needs are. Talk about their needs too, about potentials for them. If you do that over time, they will develop that trust in you. You may have to go back to your head office, and maybe there's a plan giving nerd sitting out there and say, look, I need your help on this. As it's developing and things like that, and I may want you to, you know, meet. It's a team approach. Your accountant from your organization who sets up the charitable remainder, effectively does the charitable remainder trust. You may say, I want you to meet that person. Okay, but it's about those things that you're bringing people to it and trust. And you're talking, even if you have to go and call an allied professional to help, you know, in like an outside professional working, you know, in a sense for you to do it, but you're working for them. All you've got to do is talk, be honest, not be arrogant, not it's all about me. It's about, this is terrific if we can do this, and you're a repayer and this will be a way of doing it, but let's find a way that's really great for you and that your kids will really like, you know, your holding company. Let's bring in your kids to see there's maybe a way for them, ultimately for them to save money on this because they're a beneficiary of June grandma type of thing, that they'll get the best bang. It'll be really good for them too. Let's do that. Be honest. Just be straightforward, honest. Don't bullshit. If you don't know, don't say, I don't know, but I'll get you the information. Don't bullshit.
Yeah, absolutely. Gary has a great question. Where in all the different aspects that you talked about, where do donors who have their own private foundations fit in?
It's okay. If they're making the gift from their private foundation, okay, to you, fine. They've presumably done, you know, processes to get money into the private foundation. Okay, so that's, you know, that's just send the money over. There's when you're in a private foundation, send the money. You're not sending marketable securities, you know, and anything like that. It's there already. But if it's a private foundation and you say you have to fund the private foundation to get money in, then your ideas can still working can still work to fund a private foundation. In other words, for June grandma, if there is a private foundation in the family, the working of transferring shares to reduce the value of the holding company, right, can work into the private foundation, and then making that dividend out of the capital dividend account tax-free reduces the value of the holding company. So it's a way for them to do it, and the money goes into private foundation and then ultimately can come to you. So even if they have a private foundation and you're helping them with, okay, the planned gift isn't to come into our hospital, into our university, into our social service organization, but it's coming into your in your own private foundation. Where we want the gifts to come not into a private foundation may involve things like cumulative preferred shares that we're going to see, where it may have to come right into your public foundation and not the private foundation. But we'll see that.
Okay. And I know that you've really intrigued us on the whole idea of taking receiving a gift of securities and holding it. A lot of questions buzzing. How does CRA feel about this? How do we calculate the valuation then of the gift?
The valuation is on the date of transfer, the closing price of the stock, of the public company stock. Boom, that's the value, that's the gift.
And if the company holds the shares?
Your policy is, yes, we sell them. In some cases, we hold on to them. We hold on to it. And there was a recent instance in last year, again, for another institution that was sort of helping, in which a private foundation found out that an investment it had was off base, because private foundations cannot just hold on to things to a certain limit, and they found it's off base, and they wanted to get rid of it, otherwise they'd be subject to penalties. And they called the institution and said, oh, we want to transfer it to you. Ultimately, it's going to go to you, like we want, but please hold on to it, because we've made this investment for it to grow in value and for you to get that value. Hold on to it. And the institution said, oh, we don't do this. We don't hold on to it. We don't do anything. But then over time, we managed to get it done, and it did go to that institution, and they're holding it. Okay, so it's about rethinking a little bit. We sell stuff because it's the best thing to do. We don't want to gamble on it. We want to turn it in, we want to have an investment procedure which has got a lot of different things in it that mitigates risks and things like that. That's why we sell the stock we get. But if there's a situation where we're building a fund and there's a purpose to the long term too, okay, let's document it. Let's keep it as, oh, we need special permission to do that. So who do I speak to in our institution to say, yeah, this is one of our exceptions because of the reasons why? Sure.
Mm-hmm. And if a company holds the shares, what happens to the capital dividend? Isn't that supposed to be a free incentive for the donor? Tax-free incentive?
I don't understand. If
the company holds the shares, and I'm just going to read verbatim. If the company holds the shares, what happens to the capital dividend that is supposed to be a tax-free incentive?
The company is just holding shares, they're not selling it. They're not gifting it. So no capital dividend account is created. Okay, the company has to do something. It either has to sell the shares or it has to gift the shares to get that capital dividend. And so that's the precipitation of the gift, where you might not ordinarily do it right now, but you might say, hey, if I do this, I create capital dividend account, fine. Okay, should the shares be sold? Okay, well, for June, it makes no difference, right? She has bank shares and things like that. Sell the shares, what difference does it make? To Dev, where he might say, I don't want to sell the shares. I don't want to put it on the market right now. Then you hold. But it's not the holding company. The holding company has held those shares. There's no capital dividend account until a transaction happens. But because of that, that may precipitate a gift to you before you would otherwise have gotten it.
Okay, thank you. We're through a lot of questions, unless, Laura, I'm going to ask you for a little help unless I've missed something.
We do have quite a few questions there, but you know what, we're actually over time too. But
We are.
I know, Marilyn, you'll close off with where people can get answers and ask more questions.
Yeah, absolutely. Thank you. And I want to remind everybody that it will be helpful to you, and we're pleased as Pear Tree to make this available to you through multiple sessions. So we look forward to seeing all of you next week. Any parting words, Bobby?
Do the valuation, please. do the evaluation?
Do the evaluation. Thank you. Yes, absolutely. Do the evaluation. That helps us all.
Because
Thank you.
again, this is very difficult. I'm not seeing you and you're seeing me, but whatever. Nice painting though. You know, so if you're uncomfortable with something or whatever, or feel more time on this or something, like, please tell us so that number 2, 3, and 4 can go on a different way.
Yeah, we have had a couple of comments come through the chat room that we are moving quickly. You know, the realities of what we have to do within the time that we have, but we can work with
The
that.
objective of today is start knowing your donors. It wasn't capital dividend account. It wasn't any of that. We're going to get into all of that. You're going to see the nerd in action.
We look forward to it. Thank you, everybody, for joining us this morning. We look forward to the next few sessions with you. Thank you, Bobby. You know, always a pleasure to hear you. And I think, to me, you're like a scientist who really has an incredible bedside manner, or a surgeon, because you can boil it down and make it understandable.